Although inflation is easing in advanced economies due to improved supply and weaker demand, locally, inflation is projected to further rise due to higher fuel and non-food prices. In his first post-monetary policy committee meeting, Central Bank Governor Dr. Kamau Thugge said the decision to review upward the benchmark lending rate by 100 basis points to an 83-month high was to anchor inflationary expectations and address any potential impact of tax measures in the Finance Act 2023.
The fighting of the second round effects is precisely what we are trying to do with the increasing of the CBR from 9.5 to 10.5. We are very concerned about the trend in the non-food, non-fuel inflation. For some time, it has been below 3%. It is now above 4%.
He says the reduction in the import declaration fee to 2.5% and railway development levy at 1.5% is likely to lower the impact of the new tax measures on inflation.
So these will mitigate any impact that may arise from the VAT on fuel. But we do expect some increase in July. But overall, given the actions that we are now taking, we actually do expect that by August, earliest and latest by September.
Dr. Thugge says the government is exploring floating a dollar-denominated bond locally to mop up excess dollars as well as encourage diaspora inflows.
And that will increase the supply of foreign exchange, which obviously would come to the national treasury first, and then obviously it will go to the national treasury would switch or would swap shillings for and give the central bank dollars and retain the shillings for their own expenditure. So it's discussion that we will have with the national treasury, and to see whether it can be done.
He expects the current account deficit to narrow from 5.1% to 4.8% after inflows amounting to $200 billion from the IMF and other development partners are received.